Okay, welcome to Chapter 36. Now, with Chapter 36, we are starting uh, a new and indeed the largest section of Business Law 2. And this section is all about different forms of business organization. And we're going to start off with sole proprietorships and franchisees in this chapter, moving on to some partnerships in the next, and eventually getting to the heart of this unit, which is going to be corporate structure. And we'll also do kind of a comparison, and we're going to do those comparisons throughout the course. We're going to look at comparisons of structure of partnerships, limited partnerships, but at the end we'll talk a little bit about comparing franchisees and partnerships to corporations and some of the advantages and disadvantages, and occasionally we'll stray outside of your book. I do like to include information that is relevant to just North Carolina. I do like to give you some statistical information. I think it's very useful for you. And I do like to give you some samples, so you'll see some samples, sample documents, things like that, that again are not in your text. And usually that will not necessarily appear on the exam. It's really more for your edification. It's to help you. Um, so we're going to look at small businesses and franchises here first. Um, and then, as I said, we'll move on in the next chapter to partnerships, and then we're gradually going to move on to the big bulk of this, which is going to be corporate. And that'll take us several chapters, but at the beginning here, just a couple quick ones. Okay, so the first thing to remember is, at least in regards to the relative numbers, now not necessarily the relative wealth, about 2/3 of all businesses in the United States, all firms, are sole proprietorships. And these can be very simple organizations. It can simply be someone, Joe's Drywall, Joe's Plumbing. They slap a magnet that says Joe's Drywall on their pickup truck, and they go out and they start putting up drywall for people. These can be very small businesses. They almost always are small businesses. 99% of them are less than $1 million. But they constitute 3/4 of all the sole proprietorships constitute 3/4 of all the business organization in the United States. Now again, that's not necessarily wealth, because a company like Amazon's got a lot of money, but it can be in raw numbers. The management of these are very informal, we'll say, and let's start looking, speaking of management, of the advantages and disadvantages of these sole proprietorships. Now your book lists 5 real good ones to think about. First of all, very easy to manage. If Joe's Drywalls wants to put a job in, he does it. If he doesn't want to go to work that day, he lays off. If Joe Drywall makes money, if he gets a lot of good jobs and he gets good reputation, he's constantly earning money, that money's going to go to him. There's no shareholders, there's nobody else, it's his. They're very easy to organize. As I said, you slap the magnet on the truck, you go out and you work. Of course, you got to get the jobs. I didn't say it's easy to make money, I said it's easy to organize. They're very flexible, so he might find, well, there's not a lot of drywall work, but there's a lot of ceiling work, or there's a lot of plumbing work, and I'm also a licensed plumber, so I'm gonna change the name from Joe's Drywall to Joe's Drywall and Plumbing. And it's taxed only on the profits of the owner. Now let's talk about one that's kind of missing from that list. And in the economy, they talk about the underground economy. You've got the formal economy where we know how much was bought and how much was sold, but also some money doesn't get reported. So Joe's Plumbing may go out, or Joe's Drywall may go out, they may get a job, and the guy might say, well, here's cash. And Joe might say, well, I don't want to report that to the IRS, then I got to pay self-employment tax, and I got to pay all these taxes, so I'll just stick the money in my pocket. I'll spend it, the cash, it'll never go through my bank. That's an advantage. Now, it's illegal to operate in this kind of gray market, but it's not uncommon. And it can be as simple as, if a waitress gets a tip, do they always get reported to the full amount? To, even more significant, $2,000 or $3,000 job, does that get reported? So that's an advantage. Now, that can only be pressed too far, and I think that's why you see less gray economy at very large scales, at least in using that model, because there's such thing as forensic accounting, where if I look at what house you're living in, what car you're driving, with a little bit of extra information, I can figure out how much money you're making, how much you're spending. If it turns out that you're making a good deal more than you're spending, because you're spending a lot of money and you're making it, and it's not getting reported, the IRS can figure that out eventually, or the North Carolina Department of Revenue. So what are some disadvantages of these sole proprietorships? Well, unlimited personal liability. So if Joe's drywall or plumbing makes a mistake and they flood out, they drive a nail through or screw through a pipe and it bursts and it floods a job they're at, it ruins a $20,000 floor. That's Joe's problem. I mean, they can come after Joe. They can come after his bank account. It's not a corporation problem. It's Joe's problem. It's tough to continue when the owner of these things dies. So when Joe dies, how do you keep going? How do you keep the business intact? Very hard to do. It can be hard to raise capital because banks, or lending institutions, they want some security. And, so if, like I said, if Joe dies, it's over. Well, do I want to lend $1 million to Joe's drywall? If Joe dies tomorrow, how am I going to get my money? So it can be tough to raise capital for these, particularly if they want to get big. Now let's talk about franchises. These are something that are very common in the United States. I don't think you can drive in any decent-sized town in the United States and not see what we assume to be a franchise. A McDonald's, a Burger King, a Hardee's, or the most common fast food franchise in the United States, a Subway, believe it or not. There's more Subways than McDonald's in the U.S. But there are other types of franchises. There are automobile dealer franchises. There are, manufacturing franchises. People have the right in this area to just manufacture. So there's lots of different types. And basically an owner of something, like a trademark or copyright or a trade name, is going to let somebody else use those. So you're my local McDonald's guy, you can put McDonald's on your building. But if you don't have an agreement with McDonald's Incorporated, you can't open up a restaurant and call it McDonald's. In fact, the original McDonald brothers sold the right to Roy Kroc to use McDonald's. They went back and decided to open up a restaurant. What did they call it? Well, they called it their last name, McDonald's. Kroc sued them, and they lost because they had given up that right. That right now belonged, that trade name now belonged to McDonald's Incorporated. The person who buys it is called the franchisee. The person who sells it is the franchisor. And they are in a symbiotic relationship. Each should profit off the other, but it's also sometimes somewhat adversarial. So there are different types of franchises to talk about. There's distributorship franchises. Now, the famous example of this, classic example of this, is the automobile dealership. So, and there's been some contention about these automobile dealerships. So Ford, GM, Chrysler, the big three classically, and then when the foreign companies come in, Toyota, Volkswagen, they come in and they go to a town and they say, okay, we want you to be the person that sells Volkswagens in Raleigh. So they will sell a franchise to that person. They'll say, okay, this is how many garage bays you have to have, this is how you handle repairs, this is how you do everything. Now, interestingly enough, these automobile dealerships became exceedingly profitable in the 50s and 60s, and they got a lot of legislation passed to protect themselves. Now, fast forward to the 21st century, Tesla decides, well, we don't want to use the franchise model. We want to sell direct. And there was a lot of pushback. There was a lot of law that said you couldn't do that. And Tesla's had some real issues selling its automobiles. There are chain-style operations where, and this is McDonald's is the easiest one to understand here. Franchisor demands certain standards, equipment, supplies, everything. You buy it, you now run the local McDonald's. You can also, as opposed to selling something that's already been made or selling a service or a product, you can make a product, which is a manufacturing franchise. So I might come to you and I say, I've got no interest in running a air conditioning manufacturing plant in Pakistan, but you need air conditioning in Pakistan, it's hot, so I will sell you the right to manufacture Trane or Carrier air conditioning HVAC systems. Again, Coca-Cola is a good example of this as well. Coca-Cola goes to different countries and says, we won't necessarily want to own it directly, but we want to sell you the right to manufacture Coca-Cola or Pepsi or anything. And, some countries can agree to this. For a long time, you couldn't get Coca-Cola in India. They had a substitute. That's changed in the last 10 years or so at least. And, sometimes there's wars. During the Second World War, obviously, in Nazi Germany, you couldn't buy Coca-Cola, so they had to come up with their own cola. Believe it or not, this is where Fanta comes from. So next time you drink Fanta Cola, something, I've only read that in a couple of places. I haven't seen a business study on it, but that's, as I understand, to be true. As I said, there's laws governing franchises. You got Article 2 of the UCC. That's definitely going to have an impact. Most states and the federal government also have specific legislation. So you can have something like, for example, the Automobile Franchise Dealer Act. Also Petroleum Marketing Practices Act. That'll protect, something as simple as gas stations and the marketing of that. The Federal Trade Commission also regulates all this. Very critical, because you could see how people this could be almost a snake oil salesman type thing, where you're selling a franchise you claim is very valuable and you get lots of money from people and then, run away. So the FTC will have some regulations about that. Very critical about earnings projections as well. That's something that we're very interested in because, after all, you go into a franchise because it earns money. I was involved a few years back with someone who was thinking of buying a franchise. He came to me and said, and I'm going to make up the numbers to make them very simple. He said, they want me to invest $100,000 in a franchise. I say, all right, great. And we were working with accountants and stuff, but I said, you're investing $100,000. How much profit it's going to make? And he said, oh, it's going to make $20,000. I said, now, is that gross or is that profit? He said, well, that's the gross. I said, okay, well, what's your profit? He goes, 10% of that, $2,000. I said, okay, so you're going to give them $100,000 and you're going to get $2,000 a year. You're going to earn 2% on your money. Plus, you're going to work there, right? So your labor is going to be free when you go in. So is it worth working there for $2,000 a year? Now, those are very simple numbers. Numbers are a little bit more complex than that. But, that's something you really got to think about. What is the earnings projection on this? Now, also, the states can intervene. They can have regulations, often very similar to the Federal Trade Commission, although pretty weak in North Carolina. The next thing is your franchise contract, and this underlies the whole relationship. It's a contractual relationship. And if you fail to meet conditions, it's a breach of the contract. And there's a lot of emphasis on everybody dealing equitably with everybody else, good faith. And the big sticking point is how much you're going to pay for the franchise, how much money's going out. You then can pay for ongoing goods and services like, again, let's suppose you have a Hardee's franchise. They might say, okay, we want you to buy these buns from these bakers. We want you to pay us a percentage of your total sales. And the higher and the lower could be depending upon how valuable it is. All right, so the financial or the franchise disclosure document is an important piece of paper, and you're going to see a sample of that in the next slide. But basically, we want certain information given to the person that's getting ready to buy this thing. Okay, what's the name? Who's the franchise's parents? Any predecessors? Any affiliates? Are there multiple people involved here that you don't know about? What kind of business experience exists? What's your initial investment? That's a big one. What's your territory? Are there 10 franchises locally or 1? And what's your financial performance representation? How much do you think this thing's going to make? Not pie in the sky, but how much is it going to make? And that can be somewhat questionable. There's a sample franchise disclosure document I'd let you look at if you want. Okay, so your business premises. If you take something like McDonald's, they're going to control what it's going to look like. So that if you go into McDonald's in Terre Haute, or you go one in Kissimmee, or you go into one in New York City or Sacramento, they all have similarities. Specific equipment, specific structure, specific things that are being sold. Territory is very important. Some franchises can be very close to each other. I mean, there can be a Dunkin' Donuts in every other corner. Some franchises, there better be some distance between them. What's your business organization? And very often they're going to demand insurance. They're going to demand capital contribution because I'm selling you a franchise, but I don't want it to fail. McDonald's doesn't want a bunch of failed McDonald's restaurants. So they want to make sure that if you're coming in, you got the money to survive for a while. Quality control is big. If you're selling something like Coca-Cola, or you're selling McDonald's, or whatever you're selling, or a car, you want to make sure that people have a positive experience with that brand. Otherwise, what you go to sell future franchises, they won't be as profitable. So you want quality control. This is usually pretty easy to enforce. Pricing is a little bit more difficult because here you can run afoul of antitrust very easily. You know, are you trying to set up a trust, essentially? You're trying to set up a monopoly. But usually what happens is you can get price floors set, but you can't set price ceilings necessarily. Sometimes that's vice versa. But pricing agreements can be a little bit iffy. Final point here to talk about is how long do these things last? Now, typically, you know, if you got something like McDonald's or Burger King, a Subway shop, these are going to be perpetual. But sometimes you can terminate them. Sometimes there's the right to terminate them. I was reading that Cadillac is requiring its Cadillac franchises to go to electric, to have the availability of selling electric cars. And several of them that only sell a few. Now, there might be a large GM dealership. They've got a Cadillac franchise. They don't want to get into electric cars, which I would say would be a mistake, but okay. So there can be there is a provision in the contract that says if you won't follow this, you know, we're going to terminate your franchise, and it might require GM there to pay money to terminate it, or vice versa. Now, if there's wrongful termination, the franchisee very often has the most to lose here. Generally, we're going to look at good faith. Was this done in good faith or not? And if it wasn't done in good faith, there's damages. Because as I've told you, and you're probably sick of hearing, any contract can be broken, but you have to be willing to pay the penalty or the cost of breaking it. If you're not willing to do that, then don't break the contract. All right, that's about 20 minutes, 18 minutes or so of what I wanted to cover here. This was just a really quick introduction to sole proprietorship and franchises, and really just I touched some of it. I would like to say that this is an area where attorneys should operate hand in glove with accountants, particularly when they're setting these things, the franchises up, because you're going to serve your client better when you have a familiarity with the numbers, not just the law. If you're thinking about buying a franchise, like this client of mine that I was talking to you about, you know, I'm not an accountant, and an accountant's not a lawyer. So we should be able to cross-communicate. We should be able to sit down, I look at the contract, he looks at the numbers, and we come to you, since you're our boss, and we tell you this is or is not, in our opinion, a legally smart idea and a financially smart idea. Now, very often people get just carried away emotionally because people make emotional decisions all the time. And one of the things you hire attorneys for is to say no. No, this is not a good idea. And accountants as well. I often say that the smartest thing an attorney can say is sometimes, I don't want your business. That yes, maybe you can sue, or yes, maybe you can do this, but it's not a good idea and you shouldn't be involved in it. Those are good attorneys. You don't want an attorney that is just a yes man that will do whatever you want, because he will bill you to death. Because I'm going to make money if I'm working for you. But if I'm really exercising a true fiduciary relationship, it has to be one based on the idea of there's more than just me making money. That's my central concern when I'm working for someone. But there also has to be good faith with the attorney and the accountant. All right, having said that, we're going to move on to in the next chapter, partnerships, whenever you're ready.